Ever look at a massive global company and just wonder how they do it? How do they make any sense of all the dollars, euros, and yen flowing in and out? It really seems like total financial chaos, right? Well, believe it or not, there's a rule book for that chaos. And today, we're going to break down exactly how it all works. This is your quick guide to International Accounting Standard 21. All right, let me throw a puzzle at you. Imagine a company based in the US. They're selling products in euros, paying their suppliers in Japanese yen, and they own a whole subsidiary that operates in British pounds. So, how on earth do you take all of that and tell one single clear financial story that an investor, whether they're in New York or Tokyo, can actually understand? That right there, that's the exact problem IAS 21 was built to solve. And trust me, it really is a puzzle. Before we even get to the solution, you've got to appreciate the sheer scale of this, let's call it financial chaos, that global companies are dealing with every single day. I mean, think about it. Without a common set of rules, comparing a company like Sony, which reports in yen, to a company like Apple, reporting in US dollars, it would be a complete mess, almost impossible. Every single transaction would be a wild variable. IAS 21 basically acts as a universal translator. It creates a standardized way to turn all that multilingual financial data into one single, understandable language. Okay, so how do we even start to untangle this? Well, the very first, and honestly the most critical step, is for a company to figure out its financial home base. In a currency sense, where does it truly live? The standard has a specific name for this, the functional currency. And here is the absolute key takeaway. It's not always the currency of the country where the company is headquartered. You have to think of it more like the company's financial native language. It's the currency that really drives its day-to-day business. And hey, this isn't just a random guess. The standard actually gives us a checklist. You have to look at the main economic forces that are pushing and pulling on the company. What currency are your sales prices really set in? What currency are you paying your biggest cost in? Things like salaries and materials. Answering these core questions points you to your one true functional currency. So once you've nailed down your home currency, what's next? Well, now you have to figure out how to handle all the transactions that happen in other currencies. Let's get into the nitty-gritty, the day-to-day mechanics. The initial process is actually pretty straightforward. Let's say your functional currency is the US dollar, and you make a sale for 100 euros. Simple. On the day you make that sale, you look up the euro to dollar exchange rate, we call that the spot rate, and boom, you immediately record that sale in your books in US dollars. Simple as that. Every single foreign transaction gets translated the moment it happens. But of course, there's always a twist, isn't there? You recorded that sale back in January, but maybe you haven't actually been paid yet. Now it's December 31st, the end of the year, and the exchange rate has moved. That 100 euros you're owed is now worth a totally different amount in dollars. So what do you do? To solve this, IAS 21 splits everything on your books into two big buckets. First, you have monetary items. Think cash, or that 100 euro receivable we just talked about. Since their value is directly tied to a fixed amount of currency, they get updated using the new year-end exchange rate. But then you have non-monetary items, things like a building or inventory. Their value, it stays locked in at the historical rate from the day you originally bought them. Okay, so we've got the individual transactions sorted. Now, let's zoom back out to the big picture. How does an entire company, with operations all over the globe, present one unified financial story to the world? This is where something called the presentation currency comes into play. A company might have a functional currency of Japanese yen, right? But if it wants to speak to investors all around the world, it might choose to present its financial statements in a more common language, like the US dollar. This is basically a second layer of translation for the entire company. And the standard gives us a very clear three-step recipe for this. First, you take your whole balance sheet, all your assets and liabilities, and you translate them using the year-end closing rate. Second, you take your income statement, all your sales and expenses, and translate that using the rates from when those transactions actually happened. Now, because you're using different rates for different things, you're going to get a mismatch. And here's the really clever part. That difference doesn't mess with your profit and loss. Instead, it gets parked in a separate bucket in your equity. So let's talk about that final piece of the puzzle. We've seen that all these currency swings create gains and losses on paper. So where exactly do they show up, and why does that distinction matter so much to investors? It all boils down to this really important distinction. The little gains and losses from your day-to-day business, like the change in value of that €100 sale, those hit your profit or loss statement directly. But the bigger, more structural differences that come from translating an entire foreign operation, those are sent to that special place in equity called other comprehensive income. And this is huge, because it means a company's reported profit is shielded from what are basically just unrealized on-paper currency swings. And in the end, it all comes back to this one idea. This quote from the Standards Objective really sums up everything we've just talked about. The entire point of all these rules is to answer two simple but incredibly powerful questions. Which exchange rate do I use, and where do I report the changes? IAS 21 gives the global economy the clear, consistent answers it needs. So we've seen the rules that bring some order to all this currency chaos. But that leaves us with one final, much bigger question. We've talked about the accounting, sure, but what about the reality? Beyond the rules, how can a single, unexpected event that sends a currency plunging literally rewrite a successful company's story overnight, even if its actual business is still just as strong as it was the day before? Now that is something to think about.